Ladies and gentlemen, welcome to the June 2011 final quarter webcast for Cadence Capital Limited. We've just released our full year results, and as we've indicated in those results, it has been a record profit for Cadence Capital Limited. Our fund was up 82% this year and has made around 13 million of after-tax profit. During this period, we have also been ranked amongst the top 3 listed investment companies by the ASX Morningstar report. Our franking balance is currently $5.21 million, which is also a record, and equates to around 19 cents of franking credits per CDM share. What this does is allow the board and management to declare fully franked dividends up to around 48 cents without earning any future profits. This is obviously a very, very valuable asset for the business. Later this year, we will be celebrating 5 years of being listed on the Australian Stock Exchange, and we hope to coordinate that 5-year celebration with the AGM for Cadence Capital Limited. The following slide gives an outline of dividends. We have paid 9 cents of fully franked dividends for the year just finished. We have paid 3 cent interim dividend, a 3 cent final dividend, and a 3 cent special dividend. This equates to a 7% fully franked yield on the prevailing share price, which is around $1.30. You will notice in our upcoming newsletters that we've actually spelled out in detail the dividend history for the fund since listing. The next slide is really a graphical representation of our 1-year performance, pre-fees, post-fees, our 3-year performance pre-fees, post-fees, and our performance since inception, pre-fees and post-fees, and compares it to the All Ordinaries Accumulation Index. I think in the year just gone, and in particular since inception, we're pleased to say that our fund has significantly outperformed the All Ordinaries Accumulation Index. The 4th slide in the presentation shows the table that we always provide in our monthly newsletter, and that is our exposure to the market. We are currently holding roughly 30% or 35% cash and 65 to 70% equities. We are, however, considering our RHG position to be what we call quasi-cash. And the reason for that is that RHG is trading around 48 or 49 cents per share, and the company has cash or quasi-cash on its balance sheet of 48 to 49 cents per share. If we include the RHG position as quasi-cash, our cash holding is actually around 55 to 60%, meaning that we're relatively conservatively positioned in the current investment environment. Just breaking down the 2011 performance in a little bit more detail, the stocks and sectors that performed well for us: banks performed very well for us, materials were very good, commercial services and supplies were good, software and services and the insurance sector all delivered good returns for us. We had an underperformance in the technology and equipment sector as well as the telecommunications services sector. Breaking that into stocks, RHG performed very well for us this year. South Boulder was a very good investment for us. Macmillan Shakespeare, Bravura, Tower Australia Group, Bathurst Resources and Cape Lambert. TPG Telecommunications and Miko Corporation were stocks that underperformed for the portfolio for the year ended June 2011. The following slide is one that we haven't presented before, but I think one that we intend to present going forward. We always say that what we like to do and the way is to buy undervalued stocks and sell overvalued stocks, and when we can't find undervalued stocks, we like to be in cash. The second component of what we like to do is the way in which we enter and exit positions. We like to incrementally enter our positions and then let our profits run, and alternatively we like to cut our losses quickly. What this chart is showing is that in actual fact our profits over the last 2 years, we have let them run well, but we've really been quite disciplined at cutting our losses. And we think that discipline combined with the fundamental bottom-up analysis, identifying undervalued and overvalued stocks, has really helped contribute to our outperformance this year. The Other important issue that I'd like to bring up during this webcast is the fact that the board has approved and our company is about to issue a 1-for-1 bonus option issue to all existing shareholders who are on the register on the 15th of August of this year. The strike price of the bonus option will be $1.25 and it will be able to be exercised on or before September 2012. At the same time, the board of Cadence Capital Limited has also announced a 6-cent final dividend made up of a 3-cent final and a 3-cent special. Participants who exercise their option before the 21st of September 2011 will also be able to receive the 6-cent fully franked dividend. This means that for a shareholder who exercises the option before the 21st of September, they will receive that 6-cent dividend twice, i.e. 12 cents of fully franked dividend. The reason for the option issue is that we believe over time our company, Cadence Capital Limited, with a market cap of $40 million, needs to grow to around the $100 million market capitalization. This will increase liquidity for all shareholders. We're being told by the equity research houses that this will also improve our rating. We've recently been rated by Zenith on a recommended rating, and one of the issues was that we need to grow the fund to around $100 million in order to be able to qualify effectively for a highly recommended rating. And we hope over time to garner that highly recommended rating. The exercise of all those options over time, as well as performance, should grow the fund to around $100 million. The second component of the option issue and the announcement of the dividend, as well as an indication by management that we intend to pay a 6 to 7% fully franked dividend going forward, is that we're trying to attract a high-quality, medium to long-term investor who values the franking tied up in Cadence Capital Limited. For example, self-managed super funds who are approaching the age of 60 or who are what is called in drawdown mode actually benefit from being able to recover that franking from the dividend, and that is a very, very valuable asset to those type of investors. We hope over time to be able to attract medium to long-term investors who are attracted to the performance of Cadence Capital Limited, as well as the fully franked dividend yield that the company is in a position to deliver for the foreseeable future. Turning now to the current investment environment. I'm sure many of you would have read in the newspapers, been following business journals, reading, following television shows, and watching many of the commentators describe what has loosely been referred to as the global financial crisis number 2, the lack of confidence, the loss of confidence, the uncertainty surrounding the American increase of essentially their debt levels from $12 trillion to $14 trillion, and the consequent up to 20% fall in the Australian share market over the last 6 weeks. Clearly, this has been an overriding loss of confidence, and in some ways almost like a mild panic that we've experienced. And just yesterday evening, the American government has come out and indicated that they will do, I think in their words, whatever is necessary to stabilize markets and to prevent that level of panic and fear that has been in the marketplace. And we have seen some kind of recovery in the market today. Now, what does all of this mean? In our minds, this is probably what we would call more of the same. Our stock market in Australia has been trading between 4,200 and 5,200 for the last 2.5 to 3 years. And we have just seen the market fall to the bottom of that range, drop slightly below that, and the market is now retracing back within that range. How does this affect our investment strategy? Well, in some respects, we just continue to do what it is that we already do. We're looking for undervalued stocks. We add and scale into those positions and we hold them. We're also looking for overvalued stocks, and when we find them, we certainly don't want to own overvalued stocks, and we can benefit from shorting those stocks to make a profit when their share price falls. Or alternatively, in this uncertain environment, as I've already mentioned, we are holding very high levels of cash, which, when the market does fall, allows us to invest opportunistically in companies whose share prices have fallen in some cases more than 20%. We have been buying stock today in the marketplace, and we've seen many of those opportunistic situations. And so really the key message to our investors is we're simply continuing to implement the strategy that we've been implementing for 6 years, which to date has managed to allow us to generate 15% excess returns relative to the Australian stock market. We don't see this volatile environment changing in the near term, but we do believe that the continued buying of undervalued stocks and selling of overvalued stocks and holding reasonably good levels of cash will, in the long term, create opportunity and will reward our patients with higher than average returns. Ladies and gentlemen, as always, please feel free to contact our office on 02 8298 2498 if you would like to discuss Cadence Capital Limited or anything to do with the upcoming bonus option issue or our upcoming dividends or any other issues associated with any of the stocks in our portfolio. If you would like to talk to either myself, Wayne Davies or Chris Garrard, please feel free to give us a call. The other thing I always encourage people to do, existing investors as well as potential investors, is to visit our website at www.cadencecapital.com.au, where there is a lot of news and information about our company, as well as a number of newsletters, charts, and information on how the company has been performing. Thank you once again for your continued support, and in these uncertain times, we will continue to implement the same strategy we have been for the last 6 years. Thank you.